Joining me now to talk more about the economy is Gregory Daco. He is a chief economist at EY. Gregory, always good to see you, especially on a jobs day. And we do see this number actually is surprising to the downside. Just 73,000 jobs added last month, plus some very large downward revisions to June and May as well. What does this tell us about the state of the economy?
Well, I think the main thing it tells us is that economic momentum is much slower than many had believed. What we saw in the latest July jobs report was, of course, a fairly soft reading for the month of July, only 73,000 jobs added over the course of July. But much more important, there was a 258,000 downward revision to job gains in May and June. That leaves the 3-month moving average of payrolls at only 35,000 jobs per month. This is extremely low, and now the U.S. economy is essentially flirting with job losses. I think this is very important in terms of a signal of further momentum. It indicates that employers are paralyzed by tariffs, by policy uncertainty, and that immigration restraints are constraining employment growth, a key signal for most readers of the economic outlook, but also for Fed policymakers.
So, Gregory, I do want to focus on that word there that you mentioned, momentum. It sounds like, from what you're saying, that this could portend more months of decreasing job gains and perhaps job losses ahead. That momentum, are we talking 3 months out, 6 months out? What does the data tell you?
Well, the economy was slowing as we entered 2025, but now we've suffered a significant combo of supply shocks. One supply shock from trade policy and the imposition of tariffs that are quite elevated across most of our trading partners. In fact, as of August 8th, we'll now have an average tariff rate, of 18%, which would be the highest since the early 1930s on all trading partners. On top of that, we have significant immigration constraints that are reducing labor supply and essentially constraining employment growth. So as we see the labor market, which really is the key pillar to the U.S. economy, continuing to soften, that will feed into softer income growth, which will increasingly constrain consumer spending activity. We already saw initial signs of that in the June data yesterday for the PCE, personal consumption expenditures. We're going to see more of that over the summer. The renewed acceleration in inflation will erode consumers' spending power and constrain their ability to spend as we go forward, especially now if the labor market is continuing to soften.
Okay, so what do you think this means for the Fed moving forward? We had seen them hold rates steady, of course, on Wednesday. Its next meeting on rate policy is set for September.
Yeah, you've heard me say this before, but I think it's now evident that the Fed is behind the curve in terms of neutralizing monetary policy. Fed Chair Powell highlighted during the press conference that monetary policy remains moderately restrictive and that there was no sign that essentially this restrictiveness was imposing any form of inappropriate constraint on economic activity. I think we now have evidence to the contrary, and I've been arguing that Governor Waller's line of arguments and his rationale in favor of a gradual easing of monetary policy makes a lot of sense. We have an economy where there are still strong disinflationary forces on the services side. We think the tariffs will be a one-time price shock. Inflation expectations are well anchored. And now, sadly, the employment side of the mandate is showing increasing fragilities. That argues for a more neutral monetary policy stance and more easing. I think the Fed rate cut in September is very much back on the table as of today.
I do want to ask you about the executive order by President Donald Trump late yesterday. In fact, changing the range on these reciprocal tariffs, upping it in some cases, a range now between 10 to 41% on dozens of countries. How does that factor into your projections?
Well, we had already anticipated essentially an average tariff rate of 15%. We know that the effective tariff rate, which is what companies are paying in the U.S., is around 10%, because essentially when you look at custom duties that are collected and bring that relative to imports, you essentially have an effective rate that's only 2/3 of the way up to the announced tariff rate so far. Now, with all of these new announcements, and now the new baseline is essentially 15% across most trading partners, with a lot having higher tariffs than that, then that essentially raises the average tariff rate from 15% to about 18%. What that leads to is very simple: greater inflation and more demand erosion, the combo that you do not want to see, because essentially it's the stagflationary scenario that erodes spending power, constrains businesses' ability to invest, and essentially leads to lower growth and higher inflation, the worst of both worlds.
So we had seen actually a pretty decent read on second quarter GDP. 3%, I think, was the latest one that we saw, Gregory. With this now in mind, obviously the jobs market slowing, some pretty significant downward revisions. Does that change second quarter GDP outlook for you and what we might be seeing this current quarter as well?
Well, I certainly think that the second quarter GDP growth reading was a mirage. Essentially, 3% growth was only thanks to a 5 percentage point contribution from net trade as imports unwound from a surge in the first quarter. I take the average of the first and the second quarter GDP prints. In the first quarter, you had a contraction of 0.5%. In the second quarter, you had 3% growth. On average, the economy grew at about 1.2% in the first half of the year. That compares to 2.8% at the end of 2024. So a significant cooling is visible in the GDP data. Final sales, which includes consumer spending, business investment, and residential investment, also growing about 1.2% in the second quarter. So you're seeing that slowdown evidenced in most economic indicators. And unfortunately, I fear that we're going to see a muggy summer when it comes to inflation that will further constrain private sector activity.
It's been a muggy summer here in New York City. Indeed. Gregory Daco is the chief economist at EY. Great to have you. Thank you so much.
Thank you.
All right, everyone.